Betsson AB is a Swedish gambling company headquartered in Stockholm. It trades at a market cap of 22 billion Swedish kroners, or approximately $2 billion US dollars. This is at a share price of 155 Swedish kroners. This is within the upper echelon of what you may call small caps, but this is a global company within an enormous market, so I believe the company is suitable for small cap investors despite its relative size. It currently trades at a free cash flow yield of around 10% without the need to retain capital in order to grow. However, it retains 50% of earnings in order to acquire companies in regulated markets. This is due to a looming risk where a substantial part of earnings could disappear in the coming years. Despite the free cash flow yield of 10%, it's still growing earnings double digits. Its earnings multiple at a PE of 10 times seems very low compared to growth, but this is due to regulatory concerns. Despite the warranted concerns, I believe the current valuation is very attractive. However, the path towards the returns may be lumpy and scare off many potential investors. Betsson AB traces its roots back to the 1960s when it started out in slot machines. Over time, the company has shifted its focus towards online gambling, becoming one of the early adopters in Europe as digital gaming began to gain traction in the late 90s and early 2000s. The company operates under a holding structure, but its business is conducted through multiple brands. Among its best-known brands are Betsson, Betsafe, NordicBet, and Inkabet in South America. These brands cover the full spectrum of online gambling, casino games, sports betting, poker, and other digital products. Betsson AB is listed on the Nasdaq Stockholm exchange. The company has built a reputation for being one of the leading operators in regulated markets, and it holds licenses in several European countries as well as in Latin America. Most notably though, the company is not present in North America. More on this later. Internationally, Betsson has also gained visibility through sponsorships, most notably with Inter Milan, who reached the Champions League final in 2025. Over the past decade, Betsson has grown revenue steadily by more than 10% annually. This growth has been achieved both organically and through acquisitions. Despite investing heavily in expansion, the company is consistently profitable and maintains a healthy dividend. One defining strategic decision was Betsson's choice not to enter the US market. When US online gambling was hyped a few years ago, many companies, such as DraftKings and Kindred, poured capital into the market, chasing growth. Returns have been disappointing. CEO Pontus Lindwall, who has led Betsson on and off since the early 1990s, took a different view. He judged the US regulatory landscape as fragmented and high risk. Instead of following the hype, Betsson invested in less glamorous regions like Latin America. This patience has paid off. In 2020, Betsson had no revenues from Latin America. Today, the region represents more than 20% of group revenues and growth is increasing. The region is growing in many ways. The economy is growing, more people are moving online, the football and sports interests in the region are massive, regulations are coming and improving markets. Betsson is one of the leaders here, and returns and growth has been very strong. The region will likely grow profitably for many years, and Betsson are likely to outgrow the market. The CEO, Pontus Lindwall, deserves special attention. He is one of the pioneers of the online gaming industry, having also founded NetEnt, which later became part of Evolution Gaming. His father was active in the industry as well, so he combines long-term experience with deep sector knowledge. Importantly, Lindwall owns a significant amount of stock, aligning his interest with shareholders. Perhaps his greatest strength is capital allocation. His decision to avoid the US hype cycle and instead double down on more profitable emerging markets illustrate disciplined long-term thinking. Betsson is an established player in Europe and in Central Asia. Revenues from regulated markets are now nearly 70%, which decreases the risk in the company. While Betsson has diversified, one major risk remains. A substantial portion of its earnings is believed to come from its relationship with Realm in the unregulated Turkish market. The company does not disclose exact figures, but estimates suggest that Turkey could account for a very large share of profits, and this is a black market. This represents a real risk. Such earnings could disappear overnight. However, Betsson has managed this exposure for many years and continuously reinvests Turkish cash flows into regulated markets like Latin America and Europe. Still, investors must be prepared for the possibility of a sudden hit. The market recognizes this risk, which is why Betsson trades at a relatively low valuation compared to its earnings and growth prospects. I believe that even if you take an extremely conservative approach and takes away 50% of earnings, the company can still justify its valuation. At today's share price of around 155 Swedish kroners, Betsson trades at about 10 times earnings. The dividend yield is roughly 6% and dividends grow in line with earnings. For the valuation exercise, I will take two different approaches. This is because of the risk of the company losing all earnings from Turkey. In the first scenario, the company loses earnings from Turkey, but due to growth in other markets, earnings will still grow 5% annually over the next 5 years. This will be very lumpy, of course, as earnings will fall substantially in the year where the turkey is killed. Let's say that within 3 years, the company loses 50% of earnings because of Turkey. This would mean that the remaining 50% of today's earnings has to grow 20% annually in order for the total earnings to grow 5% per annum. This is achievable for Betsson. Growth in Latin America will be very strong and comes from a very low base. And remember, 50% of earnings from Turkey is overly pessimistic, but I only assume this to show that the current earnings multiple in Betsson is more than taking into account the riskiness of the Turkey cash flows. As Betsson grows in regulated markets, the multiple on the stock should increase. If you take a negative view and estimates that earnings will only grow 5% annually for the next 5 years because of the company losing the earnings from Turkey entirely, I believe the company should trade at a multiple of 15 times. This is a 50% multiple expansion from here. Meanwhile, the shareholder yield through the dividend sits at 6%. 6% dividend plus 5% growth yields an 11% return. This is a solid return. However, the company should get a higher multiple due to a significantly lower risk. With a 50% multiple expansion from 10 times to 15 times earnings, the share gets an additional CAGR of 8% per annum. This means that total returns will be approximately 19%, assuming reinvested dividends at the same return. This example showcases that to achieve a great return in the stock, if the Turkey earnings disappears, you do need multiple expansion. I believe this will happen due to the growth and economic strength of the company. In the second example, I assume that Turkey earnings will not disappear, but that the company does not get any multiple expansion. This is fair due to the risk. In this case, an annual earnings growth of more than 10% is likely. This is probably underestimating the earnings potential, but I do this to have a conservative view on the company. In addition to the dividend of 6%, the CAGR will be around 16% per annum. This is also a great return at conservative estimates. Betsson AB is an interesting company with great financials and growth. Regulatory headwinds means that the share price performance will be very lumpy. Short-term volatility is likely, but long-term risk-reward is skewed positively. Investors should be prepared for double-digit drops in the share price. However, the future of the company is bright and current valuation is pricing in a lot of risk. In the short run, the stock could perform horribly, for example if short-term earnings growth stagnates or due to regulatory events. However, the current share price at 155 Swedish kroners is low enough for a shareholder return above 15% per annum in my estimations. This return may be achieved in many different ways, through dividends, earnings growth, multiple expansion, or future buybacks at low valuations. However, the company will keep its strong position in regulated markets and has a supreme capital allocator with skin in the game and industry expertise. As always, this is not financial advice and an investment carries severe risk. Thanks for listening.